Another very exciting edition of Market Talks. I am Market Takes. Wow, messed up the name of my own show. Anyway, I am Dion Rabouin. I'm here in the office again. I got the big boss man, Charles Farrell's office. He's let me use it again. We had those audio issues last week. We wanted to make sure and get that right for you all this week, so I appreciate you sticking with me. Those should be all taken care of today, and we should be able to dive straight into the big CPI inflation report that came out this morning. So thank you very much for being with us. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. So welcome in to Market Takes. Look, today's report was a big one because it's a narrative shifter when it comes to the pace of inflation, the pace that I think we can expect to see moving forward throughout the year, and the pace that we were expecting to see from August. So we are going to dive into all that. We're going to talk about what we saw in the report. We're also going to talk about how markets reacted. If you're looking at your screen, you're seeing a lot of red in the stock market. You're seeing bond yields spiking through the roof, commodity prices moving, crypto, really across the board. This report got traders' fingers moving. So we're going to talk about why that was. We're also going to talk about how the report stacked up to expectations, because that's a big part of the market moves that we're seeing right now. We're going to talk about some of the more important details and the big takeaways from the report. So thank you so much for being with us here on Market Takes. Let's get into it. Look, the August CPI number was 8.3%. I got it up right here on my laptop for the year, and it was up 0.1% for the month. Those numbers, without context, just kind of sound like whatever. It's where we've been. But they were definitely higher than expectations. And also, we've got to look at the core CPI report, that report that takes out volatile food and energy prices. That number was higher than expected as well. And this core number is probably a lot of what's moving the market. This accelerating core number is really a big part of Federal Reserve expectations and what the market expects the Fed to do. And today's report really changed a lot of that because the Fed has talked about how core prices are kind of a future-looking index. They sort of signal what's on tap for the future, and those numbers came in very high. We saw on the core report an increase of 0.6%, which was about double the expectation for the month, and core prices rose 6.3% for the year, again coming in above expectations. I want to drop one quick note from the report that I thought was interesting. This is directly from the Consumer Price Index report that we got this morning. Quote, increases in the shelter, food, and medical care indexes were the largest of many contributors to the broad-based monthly all items increase. So what does that tell you? It tells you that the increases that we saw were based on food, based on shelter, and medical. Those are three things that, gas prices have been moving the needle a lot on inflation expectations, but food and shelter, what you pay at the grocery store, what you're paying every time you go out to eat, that's going to start to move the needle. And I think that's something that we got to look out for in the coming months. I'll talk more about that later. Also, falling gas prices had been a big part of the overall expectation for inflation to decline and for the projections that folks have been talking about. We saw gas prices decrease by 10.6%. The CPI gasoline index fell by 10.6%, almost 11% in August, and still you got this big increase, or this above expected increase, 8.3% on the overall CPI. Gas prices have fallen 90 days straight, and even that wasn't enough to get us to expectations on the CPI report. That's notable, and I think that's a lot of what you're seeing in the markets. I talked a lot about the changing expectations for consumers about inflation. The New York Fed had a survey that came out just yesterday. It's August survey of consumer expectations, showing year-ahead expectations for inflation had dropped down below 6% to 5.7%. That was the lowest they had been since November, and the three-year inflation expectations had dropped to 2.8%. Much closer to the Fed's target. They had been hovering around that 3% level for quite some time. That had been concerning the Fed for a while. Federal Reserve Chairman Jerome Powell said last Thursday, quote, "It is very important that inflation expectations remain anchored. I think the evidence today is that if you look at longer-term expectations by households, businesses and forecasters, and also markets, you'll see that they are pretty well anchored around 2%. After today, that may be changing." Also, food. we got to talk about food. That's a big part of this report was all about food and all about shelter. The food component rose 0.8% in August. That has continued to rise even as the headline CPI has been falling. So we're seeing food prices continuing to rise even as the overall core or the overall prices on the CPI have come down. Remember, we were at 9.1% back in June, 8.5% in July, now 8.3% here in August, but we've seen ticking up month over month of those food prices. What you're paying in the grocery store is rising even as overall inflation is decreasing. Food is something that everybody buys. This is big for consumer sentiment. We get the consumer sentiment numbers, the final ones at the end of this month. I think those are going to be interesting to watch. We'll be here on Market Takes talking about those, so I hope you'll join us then. Housing, the other big thing, shelter. Housing rose by more than expected and by the largest amount all year in this report. Look, housing is a lagging indicator on these reports. It takes the folks at the Bureau of Labor Statistics a few months, it takes them a little time to really get housing prices factored into the report. And what we're seeing is that maybe the increases that folks were paying for in housing have been understated in previous CPI reports, and so we could see that housing number continue to rise throughout the year as the numbers start to get put into the report. That would mean that inflation either stays steady or starts to rise a little bit higher. That's not good news for folks expecting these CPI reports or the CPI numbers to continue to come down and get lower. And also remember on housing and shelter are the biggest components of the CPI, about 40% of the overall report. So as we see the price of housing steadily increase as the numbers get fed in, you're seeing the CPI, it's staying right around higher levels, and that could hold up and cause the Fed to do more. That's not good for markets. That's certainly not good for the stock market. And if you're a bond investor holding those bonds, that's not good for the price of bonds either. So look, let's check in with markets right now, see about the immediate reaction that we got coming out of this number. The number hit at 8:30 a.m. You saw an immediate spike higher in those bond yields, an immediate turn down lower of stock prices. Let's head to WSJ.com right now and see where we are on the markets. You are still seeing right now those stock prices down, and they've just been tumbling lower throughout the day. You got the NASDAQ down about 3.2%, S&P down 2.5%, the Dow down about 2.2%. As we look at the bond yields, I think that's really where the story is right now. If you're looking at bonds, those yields are coming back down on the longer dated bonds. I'm looking at the 30-year and the 10-year, and I'm seeing the bonds spiked up after the CPI report came out, and they're kind of gradually coming back down on those longer dated bonds. The shorter dated bonds, on the other hand, those are coming down as well. You're seeing the 2-year and the 1-year both come down. Prices right now just a little bit lower for those shorter dated bonds. 2-year, 3-year, going all the way up to the 5-year is actually still pretty high. So on the 10-year note, which is the main one that everyone follows, the market benchmark, you're seeing those prices or those yields still higher, but we are seeing a significant move in the market right now on the bond side. That doesn't just hurt bond investors. Remember, the U.S. government, when it's borrowing money and it has to pay that money back, that's higher costs for the U.S. government. That could mean a lot of things on the debt side when it comes to, borrowing by the government. It could mean that some programs that would be financed can't. The Republicans and Democrats, kind of at loggerheads because it's going to be more expensive to borrow money. That's certainly something to keep in mind. As we look out, I thought perhaps the most interesting reaction to this number was what we saw from Fed fund futures prices, and that's basically folks predicting what the Fed's going to do. Initially coming into this, before the CPI report, you saw expectations largely for a 75 basis point rate increase. What that means is it's about 3 times the normal pace that we've seen from the Fed in modern history. Usually they raise about 25 basis points to not, do too much, not scare the market, not move rates by, a ridiculous amount. Well, they've gone 3 times that amount twice. Expectations had been for that coming in, but today after the report, we are seeing expectations for 100 basis points. We're now seeing a 20% expectation according to CME Group's FedWatch tool. of a 100 basis point increase. That's 4 times the normal rate, and that is a big move for the market. So that's definitely the move and the market to watch, I think, today is what we're seeing in expectations for the Fed, because that moves everything. As we're seeing across the board right now, commodities are lower. Oil has ticked up just a little bit. It's hanging out in positive territory, but you could see that change as we go through today. But that's just WTI. Brent crude is lower. Gold is down about 1.4%. Silver way lower. Copper down by about 1%. Corn down by a lot. And also, as we look out at currencies, we're seeing the dollar really turn back higher. The euro is down about 1% against the dollar. The dollar is higher against the yen, higher against the British pound, basically across, basically across the board, as folks price in more work from the Federal Reserve, more rate hikes, higher rates in the U.S. that draws money into U.S. Treasuries and other U.S.-based assets. That means people want to hold the dollar, makes it a stronger currency. That's good for Americans if you're traveling. I got a trip coming up in about a month. Very good for me. I'm going over to Europe, baby. So I'm going to spend those euros that are about 1-to-1 right now. But if you're a business that does business, or that does commerce, basically, if you're operating multinationally in China, in Japan, in Europe, means your profits take a big hit. And we did a report and a video on that a few months ago. I invite you to check that out. The biggest takeaway, though, right now is more expectations for the Fed to have more to do and to raise rates by more, not just this year, but into next year. That's the big takeaway from this report. Again, expectations were for this report to show an 8% increase year over year and a decline of 0.1% month over month. Well above that. The number came in well above that, 8.3% in terms of the year over year, and up 0.1% instead of down 0.1% for the month. A core CPI was expected to be 6%, came in at 6.3%. Now we're on kind of the wrong trajectory. Core CPI, the Fed wants that to decline. It wants core CPI to go down because that's what they feel like they have more control over. Core CPI was 5.9%. Last month, it was expected to be 6%, instead 6.3%. So you're seeing those higher rates of inflation likely causing the Fed to do more at its meeting this month and likely causing the Fed to do more throughout the year. You're seeing those prices are booked into Fed fund futures prices and expectations across the market. Let's check out the big takeaways, I think, from this report as we're winding down here, getting close to the end of the live stream. Watch out for housing costs. Listen, that's been a lagging indicator, and like I said, that could continue to push inflation prices higher. We've talked a lot about gas prices. We've talked a lot about used cars, autos, all those things, because those were really skyrocketing higher. Those have started to come down, but they're small pieces of the report. The housing is about 40% of the overall CPI number, and it is just continuing to rise higher. If we see that trend move forward in the months ahead, we could see CPI not only stay at these levels, but maybe start to rise again, and we could start to question that peak inflation that kind of everyone had agreed to back in June, that we had reached peak inflation at 9.1%. If housing keeps rising higher, housing is a big input, and that could move overall CPI higher. Definitely watch that. Also good to watch food prices. That's another big part of this index, and food prices have continued to move higher. We were expecting that to economists were expecting that to move lower. That did not happen this month. And remember, we thought inflation had peaked back in March, and then it picked back up in June, came down again. We could see another pick back up. That would be a real tragedy for the market, especially for stock investors, especially for folks who are invested in those risky assets. Crypto is just taking a bath right now. You're seeing Ether and Bitcoin down big, about 3, 4, 5% right now this morning. Our last takeaways as we come to the end of this live stream. Economists are really starting to worry more that the Fed is doing too much. And this report is likely going to give them more ammunition, more firepower to say that we need to keep raising rates at a fast pace, get out ahead of this thing and do more. And there are more economists who are starting to say, well, we don't know that you really need to do all that much. Maybe you're doing more harm than good by raising rates at this rate and by choking off the economy's growth rate. Remember, we've had back-to-back quarters of negative GDP growth already this year, the third quarter was looking good, like we were going to have positive growth, but that could be in question as the Fed needs to do more on the rate side, or as the Fed likely feels they need to do more on the rate side. Today's news likely puts the wind at their back to say we've got to do more. That Fed press conference on September 21st, that's going to be on Wednesday. We are going to be right here for Market Takes. Hopefully Charles Farrell lets us use the office again, but we might be in a new home. But we'll be right here on YouTube delivering you the Market Takes, talking about what we heard from the Federal Reserve and Fed Chair Jerome Powell. Also, one quick thing on the housing note, be sure and check out the video we just put out yesterday on renting versus buying. Right now, the mortgage rates rising higher have made it the worst time to buy in a very long time. The reaction today from CPI and from the market suggests that mortgage rates are going to tick even higher, and that could hurt the housing market even more. So check out that report we did yesterday, that video that we did yesterday. It's on my YouTube channel, Why Now is a Terrible Time to Buy a House. Listen, thank you guys again for being with me. I am Dion, Rabouin, reporter at the Wall Street Journal. That is going to do it for the live stream today. Thank you for tuning into Market Takes, and be with us on Wednesday, September 21st, as we talk through the FOMC meeting, the Federal Reserve's policy meeting, Fed Chair Jerome Powell's press conference afterwards. We're going to be breaking all that down, talking about the summary of economic projections, the market, all of that. I hope you be here. Don't be that's a square. And that's going to do it for us here on Market Takes. Thanks again for being with us. Dion Rabouin, and I hope to see you next week.